A little more smile.
Good morning, and welcome to the first meeting of the Income-Based Education Tax Study Committee. Are there nominations for co-chair of this committee?
Yeah, I would like to nominate Senator Cummings for one of the co-chairs.
Second.
Great.
Are we going to do it as a?
Then you say any further nominations?
Any further nominations?
Yes, I would like to nominate Representative Kornheiser to be co-chair.
Thank you. Is there a second?
Second.
And so,
Further.
Any further nominations?
any further nominations? Okay,
And then you close the nomination,
I close the nominations.
and then we should vote.
Okay, shall we take a vote one by one or at the same time?
Same time.
Same
Same time
time,
is fine.
okay. So taking a vote for co-chairs of Senator Cummings and Representative Kornheiser.
Aye.
Aye.
The ayes have it.
And did you vote?
Oh,
I did.
Okay.
Hot. It's such a hotly contested position.
We wanted to be sure you wanted it.
Thank
Great.
you very much.
Thank you for the guidance. I appreciate it.
Yes, yeah.
Okay.
So thank you for the nomination for co-chair. And I think Senator Cummings and I might have known this was coming and talked beforehand. And I think I'm going to chair this meeting and then she'll chair the next one. We'll take turns. So that said, would love to get started or not.
We were going to set meeting dates.
We were.
I just wanted to remind everybody that our committee page is not on the General Assembly website. It's on the Joint Fiscal Office website. If you have questions about where that is, that's where all our documents and agendas are.
Does everyone know how to find that, navigate that? Had fun Joint Fiscal Office sponsored meetings before? Okay, great. So if we could just
We're diving into scheduling first.
start with scheduling so that we don't forget it under any circumstances.
Okay.
If, say, the hurricane comes faster, this is the most important thing we can do today. So my preference is to do this with I suggest things, and if you're a no, you say so. If you're a yes, you can just stay silent. Does that work? And does that work?
That worked.
Great, okay.
Getting my calendar out.
Okay, I'm gonna go for Wednesdays, and if Wednesdays don't work, I'll go for other days. And thinking we have one meeting in September, 2 in October, 2 in November, 1 in December. That's my goal, okay. So in October, the 12th,
Can do.
success.
Right, we are good at this.
10 to 4?
Yes, 10 to 4, 12th. And the 26th,
I won't.
Hold on. I can't put it on.
My son's graduating from college.
The 26th. Can do.
okay, 26th.
And the 4 again.
Yes. How's the 2nd of November?
Yep.
Okay,
So that's a week later.
it's a week later. The 9th is already a joint fiscal committee meeting, which is why I'm,
I think it's fine, just as not going to give us a lot of opportunity to collect things in there.
yes.
Just see. Yeah, I can do it.
I'm gonna try for the 10th of November too.
So the 2nd of November, and,
Yeah, we're gonna hold the 2nd tentatively.
okay.
And Sorcha will send out save the dates for everyone. You don't have to retain this information. How's November 10th? That's a Thursday.
Actually, it's Tuesday.
It's true, thank you.
The 10th is.
Okay,
Thursday.
it's a Thursday. Okay, we're going to hold the 10th as well.
Okay.
Is Thanksgiving the 24th? It's not in my calendar.
Yes.
Okay,
You're not gonna make us come in on.
not doing that. We'll be cooking. Okay,
So that's, okay. And that's another, so we're
Yep, that
meeting 3
week.
weeks in a row. I just want to point out that
yes, no, one of those two meetings I think we're going to cancel.
what do you mean?
Because I'm going to ask folks about the 29th.
November 29th?
November 29th.
That's going to be a very hard one for me.
Okay, November 30th.
That's fine with me.
I think that's,
I guess the week after Thanksgiving, Catherine really wanted to black out the 28th through December 2nd.
Oh, because it's the new member
Yeah.
orientation, the building will be taken over. Okay, thank you.
It's also tax like week too.
And tax letter week. Okay, we will not meet that week. The 15th of November?
That's fine.
Okay. No?
well, I thought we settled on 2nd and 10th, so
I think what we're going to do is hold 3 dates in November for now and then check with JFO to see if their
Likelihood of
spaciousness
meeting
would
all
be
three.
better desired
okay.
Second,
based on what we ask them to do.
second and the 10th and the what was the?
2nd, 10th, 15th.
Hold those.
The 15th is,
10th and 15th, is that,
15th isn't ideal.
yeah. it's
Okay,
not ideal.
no on the 15th. Okay,
Better do the 14th than the 15th.
I cannot do the 14th. And I think Ann and I both can't do the 16th through the 18th. Okay. I'm gonna skip that week and the next week because it's
oh,
Thanksgiving.
is that the fiscal,
Yeah, the conference.
CSL fiscal conference?
All right, so we're canceling the 15th now?
No 15th. We're just skipping those 2 weeks. Okay.
Okay.
Oh, so we are not doing the 15th.
Nope.
All right.
Okay, I'm moving into December. 7th?
Yep.
I'm basically going to be a hard no for
Oh,
the,
I'm sorry, it's the legislative briefing.
Thank you.
On the 7th.
No on the 7th. How's the 14th?
I may be able to make that.
That's good for me.
No 14th.
The 14th is
Okay,
good or not good?
not good.
Good for me.
6th.
Yeah, it's not good for me.
Nope.
Are you out the whole week?
I am.
Oh.
Yeah, so this is one where I'm just going to have to miss it or zoom in if I can.
Last one.
Last one, so 13th.
No, that first, I could do the 16th that week, but otherwise I'm,
How's the 16th?
Great.
16th is fine.
Terrific.
16th, 16th,
Friday.
16th?
That'd be great.
Yeah.
Okay. How many did we just do?
6.
So we're meeting every week from now on.
You have 5? Oh, because this is 6.
Today is
Plus
today.
6.
This is 6.
Yeah,
Okay.
and that means we'll probably keep the 2nd and the 10th.
I think so, because we can't with the others. Okay.
Right. I'll send out invitations.
Thank you. And with that, okay, have that settled. Of course, if stuff comes up, yeah,
So it's 10 to 4, 9 to 3?
10 to 4, but Sorcia's going to send out invites to everyone.
Okay, yeah, Sorcia sends that out because I had reserved every Wednesday when you and I had talks.
Yes.
I
As
want
did
to
I.
make sure I've got the right ones deleted.
Sorcia will send out those dates to everyone and probably to the various stakeholders that are being informed of things. If you have a stakeholder that wants to stay informed about the meetings or you're watching inside the YouTube and you want to stay informed about the meetings, please get in touch with Sorcia and you can be added to the list to receive the agendas and announcements in advance. Any other logistic issues that anyone on the committee wants to? Great. Abby, would you like to join us? So basically this first day is about all understanding essentially like what's been done already, what various stakeholders have expectations and concerns about for us moving forward. And my goal for all of us leaving this meeting is that we've gotten really clear on what questions we want to answer by the end of our 6 weeks. And so we have like a really comprehensive list of what those questions are so that we can really set our agendas towards answering those questions. And we have witnesses coming at the very end to basically flag further questions for us. So take it away. Thank you.
Thank you. So for the record, Abby Shepherd, Office of Legislative Counsel. Please let me know if I'm not projecting enough. I'm going to try and get my voice all the way to the end of the room. It's a nice long table. So I'm going to start out, this might be quite brief, as I'm sure you're all aware of the enabling legislation. This was the miscellaneous education bill. And this enacted this study. There was another bill that did pass that had a similar study or report requirement, but I'm just going to review Act 175. And Sorsha has posted that on the website. If you want to follow along, it's section 5. So the purpose of this tax study committee is to study and make recommendations regarding the creation and implementation of an income-based education tax system to replace the existing homestead property tax system for education funding in this state. So it is very specific to the homestead property tax system. There are 7, really 6, and then a catch-all 7th category of powers and duties, what the study committee is expected to study and make recommendations regarding. Some of them are broad, some of them are more specific. The first is quite broad, or quite specific, sorry. It's restructuring the existing renter credit or creating a new credit or other mechanism to ensure that Vermonters who rent a primary residence participate fairly in the education income tax system. So this is getting at if there were to be a change to the homestead property tax system, how would renters who under current law are getting a renter credit, how would they be treated? Would they be paying an income-based tax? And would they also be paying through their rent the non-homestead property tax? So within that are some assumptions about how this might be structured, but it's also open to the recommendations that your committee wants to make. So it's not to forget renters while we're looking at a new system for homestead owners. The second charge is transitioning. So that's often pointed out as a potential challenge. There's a lot of complexity transitioning from the current system to a new system. There are the administrative sides. There's also the timing side. So looking at which year so the existing property tax credit, how long would that continue? What would the new system look like and when would it take place? So there's timing and then there's structural issues. The third charge is considering accurate modeling because there are differences between household income, which is currently used for the property tax credit, and adjusted gross income when you look at income tax, if you're looking at taxing income as the base, and that is the whole topic of my later presentation that you'll see also on the website. Not the modeling part because that's JFO, but just what are the criteria, what are the considerations for income? The fourth charge is whether there should be a cap on the amount of income subject to a new tax. So that's a very specific pointed question. Is there a maximum of the amount of income that will be subject to the new tax? The fifth are challenges or other considerations for administering a new tax. So that's really looking at anything that could be a potential administrative hurdle. That's where you get into the weeds, especially with drafting, is how do you fit all of these new moving parts together? The sixth charge, when looking at income as a tax base, is, and this will again probably be more of a JFO work than Ledge Council because I can write what you want, but how it actually all shakes out with the numbers is very different. How would a new education income tax potentially impact general fund revenues? and how that could potentially impact tax capacity if you have a new tax on a base that's already subject to a tax, so income as a tax base. And then lastly, there's this catch-all, any other relevant considerations. So you can really look at anything you would like. So that's the meat of your new study. Some of the more technical sides, just to let you know that you do have the administrative, technical, and legal assistance of the Agency of Education, the Vermont Department of Taxes, JFO, Legislative Council. Legislative Operations was named, but JFO is providing more of the administrative and technical side. You are required to consult with the Vermont League of Cities and Towns and any other interested stakeholders. So that's your public engagement piece there. In terms of, oh, and I'm sorry, I did skip over, if you were following along with the legislation, there are, as you are aware, 3 members from each chamber, which were named by your respective leaderships. That's unimportant to know. The deliverables are that a report is required by December 30th of this year. It is a written report to the House Committees on Education and Ways and Means and Senate Committees on Education and Finance. It must include your findings and recommendations for legislative action, and it does require proposed legislative language, which I will be helping with. The meetings are no more than 6 meetings. Your committee ceases to exist December 31st, so the day after your report is required, and you must select a chair, which has already occurred. And then you are authorized to have compensation reimbursement for attendance at these meetings. It's sort of the typical language that's put into study committees, so it's under the statutory compensation section, and there were monies appropriated to pay for that. So that is the entirety of the enabling legislation. If there are any questions, I can turn it on to Julia. Turn it over to Julia, sorry.
Yeah.
Just a question, you referenced another bill that had something similar, but that you're talking about the charge to the tax.
That's correct. That was not a legislative charge.
Yeah, and I guess I wouldn't agree that they're in the same field, but they're much more sort of, hey, help us figure out the technical tax stuff, as opposed to these are policy changes, I think. So sometimes you hear that, why are we doing both of these? To me, they're really important to bring together and not duplicative in the sense of, I don't know. So I don't know if you agree with that, but.
That's a fair characterization. This has more policy and just more charges and duties for your committee than the more technical and very specific questions that were asked of the tax department. That said, some of the language is identical, like for the renter piece in particular.
Yeah. Okay, good. I wanted to make sure we weren't being duplicative, and also just trying to make sure I understood it. So.
And I think the reason we're starting our committee's work so late in the season is so that we can be incorporating the work of the tax department into the work we're doing here. And we're going to hear from them later because they're almost done with their report.
Great.
Thanks. Talk to you again in a few minutes.
Yes, I will be back.
Julia. I feel a little out of practice with all this. How does everyone else feel?
Hello, everyone. For the record, I'm Julia Richter with the Joint Fiscal Office. There is a presentation for folks watching at home and members of the committee that I'm going to be walking through. It's a review of the education finance in Vermont, which I know members of the committee are familiar with, but it's helpful to just sort of set the stage for everyone in terms of the conversation before moving forward. So I will go through it maybe more quickly than if I were presenting to a different group of folks. That being said, feel free to stop me during the course of the presentation if there's any questions, clarifications, or things you want me to delve into more deeply. So the presentation is on the committee page under my name. For folks who want to pull it up, is it pulled up? Okay. Seeing nods, so I'm just going to get started. There is a lot of meat in this presentation so that it can be referenced at future dates, hopefully as sort of a just general reference document. But moving on to slide 2, what I'll be going through is first big picture overview, the big takeaways of Vermont's education finance. Then we'll touch on education expenditures. And then the bulk of the presentation will focus on education funding because that's the focus of this committee. So we'll talk about the non-property tax sources, the non-homestead property tax, and finally the homestead property tax and the income credits or the income sensitivity. So I'm on slide 3 now, big picture, intro to Vermont's education finance. As we know, it's different from other states. It's a statewide funding formula that's coupled with local property tax administration. Each school district's education spending is determined at a local level, and this is approved by voters, usually on town meeting day. And annually, the legislature sets the education yields and property tax rates at the level necessary to fund these education expenditures after accounting for the non-property sources. There's 2 types of property taxes. There's the homestead, and that includes that income sensitivity portion, as well as the non-homestead. And the current system is really a product following the Brigham decision, in which now the homestead property tax rate is a function of district per pupil spending. So district rates vary in proportion to per pupil spending and don't vary because of that district's property wealth. So it's really a statewide system. So we've got a slide here just kind of reviewing the process since the Brigham decision of Act 60 and Act 68. Just really to remind that over the course of time, Vermont's education finance has shifted so that the property wealth doesn't affect the base education rate, but instead local spending decisions do. I'm going to move forward with that slide unless folks have historical questions. Not seeing any. Moving on to the Ed Finance timeline. As I know you're familiar, on or before December 1st, there's the letter from the tax commissioner, which recommends, so to speak, education tax rates, but that's really just a ministerial tax. We have to solve for it based on the process set out in statute. And then it moves forward with school boards preparing their budgets, voters approve, vote on those budgets. The legislature sets the state level yields as well as the uniform non-homestead property tax rate. Then the tax department is going to set the spending adjusted homestead rate for each town based on those per pupil spending decisions. And then the towns administer the education property tax. So that's big picture. I know we flew through that. I'm not seeing any questions.
I think it's really helpful, though, to remember the fiscal year, calendar year, and how differently delayed this process is from the rest of our tax process, which has its own schedule.
Yeah, that's a great point. It is different than income tax, as I know we might be exploring more down the line. So these are just some big dates kind of that are worth keeping in your mind as we move forward.
Yeah.
The year-round box, the categorical aid payments are made throughout the year. Do you have any, this cash flow situation is going to be something we're going to have to be pretty fluent in, I think. And so I'm curious if you have just a snapshot of amounts, like the categorical aid, does that those are coming, I'm gathering monthly or something. Is that about like 1% or 5%? I mean, it's a small, I know it's small, but I'm trying to understand.
In terms of the amount, like how much school districts receive, that's education payment or categorical aid, or how is that categorical aid going out for the year?
This is helpful for me. You're saying that the ed fund disperses to districts September 10th, December 10th, and April 30th.
Mm-hmm.
But, and so that's, one of our challenges. But here, the categorical aid payments are made throughout the year. So I'm trying to understand what portion of the whole universe that is.
So that really leads into my next section quite well. But to answer your question, the education payment is about 80% of expenditures out of the ed fund. Everything else, including categorical aid, is that remaining 20%. With respect to cash flows, I think that would be, it might be helpful to bring in AOE to talk about how those funds are dispersed to the districts, as I'm really looking at sort of the big picture education fund.
Okay, thanks.
And Julia, different districts have no, that's the sort of full sum of percentages, but I imagine that some districts have a much higher percentage that comes from categorical aid or a much lower percentage.
Definitely. Thank you. So that 80%, roughly 80% that I'm talking about is at the state level. So the education payment is that aggregated sum of all districts' education spending.
But 20 categorical aid isn't 20% of the ed fund, is it?
No,
It just
so
goes out, 80% goes out. So are we talking about 20% as sort of what's retained locally and not, I mean, help me understand the difference.
Actually, if we move on to sort of help structure our thinking about how we think about the money that school districts are receiving. On slide 7, you'll see education expenditures at the local level. Okay. So this is first looking locally at districts. These budgets need to be approved by voters, and really we can think about the parts of school budgets. Really, this is really simplifying things, but really I think it's helpful to think about it sort of in 2 buckets. We've got the offsetting revenues, which includes state and federal categorical aid, as Senator Pearson is mentioning, as well as tuition revenues, prior year surpluses or deficits of the school district, and reserve funds of the school district. And that kind of fits in the bucket of offsetting revenues. And then on the other side, everything that's not offsetting revenues is education spending. So these are the funds that a school district decides to spend net of the offsetting revenues. That includes personnel costs. So that's the local level. And then when we kind of blow it out and we look statewide, we go and we think about the education fund expenditures. So education fund is the statewide fund of all public education, and this includes school budgets. And same thing, really generalized, we can think of 2 buckets of education fund expenditures. We can think of the education payment, which is the aggregated amount or the sum of all school districts' education spending that we were just talking about, what they're deciding to spend on top of those offsetting revenues, and then all other expenditures. So categorical aid, one-time appropriations, other operating and ministerial costs of the state that are paid for out of the education fund. And so this brings us to slide 9, which is kind of a snapshot of the education fund outlook, which I know we're all familiar looking at. And I put a box around the appropriation. So this is where we're really looking at the bulk of the money that's flowing out of the education fund. And here we can see in slide 10, that education payment line, which is about 80% of appropriations in fiscal year 22. So that wraps up what I was planning on saying about education expenditures, unless there's more questions.
Great, thanks.
Not seeing any. Now we're going to move on to how is the education fund filled? So I'm on slide 11 now. So Vermont pays for education, bless you, through the education fund. And same thing, thinking about buckets, right? Within the education fund, we really have kind of 2 buckets. We have the property tax sources and we have the non-property tax sources. So we can see that on the left, this green box, we have the property tax sources. So the non-homes, and I'll go into detail of how these different rates and whatnot are calculated, but Non-homestead accounts for about 39% of the education fund, homestead 34%, and non-property tax sources are that remaining amount. Yes.
I think that, that homestead education property tax number does not include the credit.
Correct.
Okay, so once the credit's applied, it's actually much smaller than 30.
It's even smaller, yeah.
Credit.
Income sensitivity.
Yeah.
Okay, not the renter credit.
Not the renter,
Okay.
but income sensitivity. Yeah.
Thank you. That's a great point, which leads me to my next slide, slide 12, where you can see that property tax credit in line 1B is being noted as sort of being taken back out, right? Because it's a property tax system that has these income sensitivity adjustments that, which I will talk about in more detail once we cover the more simple, I guess, side of things.
And that comes out of the ed fund?
Right.
Okay.
So I'm on slide 13 now. Property taxes are set so that the education fund is in balance. So the amount that needs to be raised on property taxes is determined by subtracting out the non-property tax revenues from the total uses. And there's two property tax bases for the education tax. And these are the non-homestead property and the homestead property. Got the statutory definition of homestead property here. But basically it's the principal dwelling and parcel of land surrounding the dwelling. And I'll defer to my colleague, Abby, on specific details about how that plays out. But moving on to slide 14, the non-homestead property tax. So this is so when it's equalized, so before the CLA has been applied, it's uniform across all towns, across all districts. Technically, the rate is set in statute at $1.59 per hundred, but the statute is annually not withstood by the legislature. So usually the rate is set in session law, usually in the yield bill. And then this brings us to the homestead property tax. So this is a tax on all taxable real property that qualifies as a homestead. And the key here is that it's dependent, the rate is dependent on, of each town is dependent on its locally approved education spending per equalized pupil. So I've kind of broken it out into the different sections of how we think about how this rate is calculated. First, looking at the property rate and then looking at the income sensitivity portion. So we can see here on slide 16, the calculation for the homestead property tax. So
I hope everyone's very familiar with this at this point.
yeah, I've been going quickly. I can.
Oh, please
slow
don't.
down. Okay. All right, so after voters approve the school budget, the base homestead property tax rate is adjusted by its ed spending per equalized pupil. And if a town belongs to more than one district, then the homestead tax rate is going to be weighted by enrollment in each district. And so we see the calculation here where we've got kind of three variables that we're going to be looking at: the property yield, the education spending, and the equalized pupils. So going to slide 17, the pupil weights and equalized pupils. We had a big discussion last session about pupil weights, and want to note that Act 127 added and adjusted pupil weights. It got rid of the equalization ratio. So this is going to be changing within the coming years, starting in FY25. And on slide 18, the property yield can be sort of thought about is the per equalized pupil amount that's spending that the fund can support with the uniform homestead tax rate of $1 on homestead value. And so districts that decide to spend more than the property yield will have their rates increased proportionately. districts that decide to spend less than the property yield have that base of $1. So even if they spend less than the property yield, they're still going to have a base of $1.
And Julia, JFO is doing a separate report this fall about that dollar, basically. I know it's a very loose way to describe what you're doing, but.
So Act 127 tasked us with a report that includes looking at the mechanics of setting the yield to include a base funding amount. A couple other topics as well, including cost containment. But we're looking at a couple of different options for that.
So we cannot even worry about that here because we're doing that in another place. Okay, thanks.
We're getting rid of the property tax.
Homestead.
So that is big picture, reminder, homestead property tax, how is it calculated? Now we're moving into the property tax credit. So about 70% of Vermont households receive a property tax credit. That credit is applied to bills in the following year. And it's limited by the income of taxpayers. So I put a couple of tables in this PowerPoint for you to reference in the future if you're trying to remember, where are those different numbers. But essentially, we've got these different brackets of household income and how the property tax credit is going to be calculated accordingly. So up to 90,000, the property tax credit can be used on the first 400,000 of house site value, and after 90,000 can be used on the first 225,000 of house site value, and around 135,000, that's this year, the household will never qualify for a credit.
In this case, house site, is that where we get into the home in 2 acres?
Yeah.
Yes.
I didn't see Abby over there anymore, and I was wondering who you're not to. Thanks. And another question for Abby, that 134,800, was that set in statute at that number?
That's a great question. So that is not set in statute. It's sort of the mathematical result of having the house site, and then it's where it phases out. It's set, and I'm going to look into the audience by the tax firm, and each year they do that calculation, they post it. So actually, I was trying to check this as we were going through because it changes by a couple $1,000s each year.
Thank you.
Typically in the last few years.
Yeah, so the tax department does that calculation, joint fiscal office, we also do it, and we come up with the same number, so confident in that.
When you say we do the calculation, what is it a formula based in statute? I mean, I'm sort of familiar with the number, but I'm curious, like, is there a goal does the statute say make sure 70% of households qualify, or?
Great question. It's actually just mathematically how it plays out. So it's looking at the yield and looking at, okay, at what point will a household's income never qualify for a property tax credit? So there's no goal that we're solving for. There's no intention that we're solving for. It's really just looking at the numbers and saying, okay, at what point is this income always going to be high enough that it won't qualify for a property tax credit?
Okay.
It's really just a
based
mathematical exercise, same as the December 1st letter.
That's based on money coming off of the 225, I'm assuming.
Yes.
There's just a point where it zeroes out.
Exactly.
Scott, did you?
I was saying that the 90,000 is in statute. The starting point is in statute. That's.
Mm-hmm. So the 90,000 is in statute, the 47,000 is in statute, the 400,000, the 225, those are all in statute. It's this upper bound that really is just a mathematical exercise each year.
And I think we're probably going to spend a lot more time on that very particular piece of math.
Yeah, and so is the house site defined in statute differently than homestead?
That would be a question I would defer to Abby again.
Yes.
And I think probably you need to come up to the mic. I'm sorry.
Sure, do you want me to address that?
Let's hold it until the end of the presentation, then maybe you can just sort of keep track of a few questions. Thanks. Okay, back to you.
Okay. So next I'm on slide 20, same or similar intuition of the property yield. Now we're looking at the income yield. And that's really just determining the spending adjusted income rates, which are used to help us solve for the property tax credit. Slide 21, these are the further credits, or often referred to as the circuit breaker. So this is for incomes less than 47,000. This is included in statute. And essentially, households with income under 47,000 are entitled to additional tax relief if their net education tax exceeds a fixed percentage of their household income. So you can see how that breaks out in terms of the tax cap as percent of income in those tables at the bottom of the slide. About 30% of homesteads are eligible.
And this might be a question for another day, but I'm going to ask it anyway. How many dollars out of the general fund?
I don't know. I would have to look.
Thanks.
So.
Yeah.
I'd like to understand your question. You're talking about to pay for the credit?
Yes.
Well, that was what I had asked earlier, and I thought that it comes out of the ed fund, and
That's a different credit. So the circuit breaker municipal rebate comes out of the general fund, and the income sensitivity comes out of the ed fund.
So
the renter credit comes out of general fund.
I believe so.
Yes.
So when we're looking at at this slide here, and we see the two tables, the net state education tax, this is being picked up by the education fund because this is sort of the education fund income sensitivity. The municipal homeowner rebate, that's being paid for by the general fund to kind of make those municipalities whole again.
Yeah.
And you said 30% of the homesteads eligible for the income sensitivity are eligible. Is it also about 30% that are eligible for the income sensitivity?
So about 30% are eligible for some sort of homeowner rebate that we're looking here on slide 21. The big picture income sensitivity, those income credits, that's about 70%. So about 70% of homesteads are receiving some sort of property tax credit. That's adjusting their property taxes based on their income.
And it's 30% of the 70%. It's not 30% of the whole.
Thank you.
And what is 30% of 70%? Thank you. Great. I trust Scott's math. I'm good.
Okay.
Yeah.
Any other questions on the circuit breaker? Okay, final slide. And this is really just reviewing the calculation of the property tax credits. So I'm on slide 22 here, so we can see just broken out how the different income groups will work. So we've got the different household incomes in the far most left column, then dependent on their house site value, and then the calculation in that big middle column, the calculation of the amount that would be paid under income. And then finally, the column on the right is calculating the property tax credit. So the property tax credit would be the amount paid for homestead property taxes minus, and then dependent on the different classes, what we're subtracting out. I know that it's a lot on the slide, but I think it's a helpful reference table just to be able to picture the structure of the system. That's all I had prepared for the committee today.
Thank you very much.
Yes.
Appreciate it. And your face is blocked by Peter and Chris's head respectively for me. And so Sorcia's going to see if she can move you on the screen during the break. But if I If you are jumping in, like wave a little bit or something. I'm sorry.
Yeah. You're muted.
And you're muted.
Oh,
Still muted.
I think we can.
really?
We're going to take a quick break while Abby works her way towards this table.
Would you like me to answer some of those questions that popped up and then I'll.
That would be great. Thank you.
Okay. So one of those questions was about the different statutory definitions. So I did have to just check to make sure I was getting the right citation. So you do have the homestead definition, which Julia referenced and gave you a bit of the sort of the first line of that, which talks about it being a principal dwelling, you have to occupy it. And then you also have a house site, but the house site's actually in a different chapter and it's for the property tax credit because you only look at the dwelling and the 2 acres when you're looking at house site value to determine the property tax credit. You also see that, and I was just trying to pull up, oh, there's Ann. Sorry.
I'm back.
Good. Glad you're back.
This is on a precarious race here. Okay.
Did you have anything you wanted to add before we jumped over to Abby?
No, that is helpful.
Great.
Great. I was just trying to pull up a tax bill because if you have looked at a property tax bill recently, you'll see the house site value is stated separately. So that's what the property tax credit is based on, and that's the dwelling in 2 acres. And those are both statutorily defined.
Thanks.
And the homestead, it's the home that's occupied and all surrounding property.
Yes.
So if you have 100 acres surrounding your property, it's based on that, yes.
Yes. And then you get into all different ways of structuring that current use and lots of other things that we won't look at today. So I did want to point out that my presentation for definitions of income is on the website. I will not be sharing that, but you can follow along in the way that it did. I think that will work well.
And the graphics match the senator's tie incredibly well.
We can find that out.
Yeah, okay.
So just really quick though on.
Is there any other questions?
This current use used the home site 2 acre definition of the.
Current use also looks at, those are different definitions. It has its own definitions. It's different. So
Okay, to
it's-
separate the house.
Right.
Yes, there's always the home and a certain amount carved out, and since I'm on the spot, I'm now blanking if it's 5 acres or 2 acres. But I can get back to
Okay.
you, sorry.
And Jake will spend some time with us after you, so he can
I don't know if you
dive into that if we want him to.
touch current use at all in this.
No,
That's
we do not.
a whole other, and it's shaking.
All change.
Okay. And, okay, so I will move on to talk about income. So I do get into the weeds, but I tried to stay a little more high level and not throw too much sort of noise at you around the side because they can very quickly get into a lot of other discussions. So tried to focus on income as a tax base, providing some really basic tax basics. What are we talking about? Why does this matter? So the first few slides are sort of a primer for how a tax is structured. And I apologize, in my printout, I had page numbers, but it looks like it's not showing up in the PDF. So I'll just say next slide and give you the header. So we'll look at an anatomy of a tax, and then I chose 3 different incomes that are income definitions that are currently in statute. Only the first one is used as a tax base, and only one of the definitions that's provided as a tax base. The others are definitions of income that are used to calculate credits. So it's a slightly different beast, but it is a different way of getting at. These are different ways of looking at income. There are many, many ways to define income. And then finally, it's not an exhaustive list, but I did provide a few considerations that's more looking at policy options for what you might want to keep in mind as you're thinking about how to define income. So actually it would be the 4th slide. I'm just going to skip over it. Anatomy of a tax, just trying to give you some some breaks in this somewhat. I don't have any nice pictures like Julia had, sorry. A few little graphics. So when we look at a tax, what we're talking about in this presentation, we're talking about defining income, we're talking about the tax base. So when you are calculating a tax, you have the tax base times the tax rate, and that gives you your tax liability. Tax base is defined in statute minus any exemptions and deductions. And an exemption is an exclusion from taxation. Often it's limited to a particular property or taxpayer or an item of income, for example. It can be full or partial, it can be temporary or permanent. A deduction is an amount subtracted from the tax base. So that's that very first part of the calculation that you are reducing. So it doesn't, if you do have an exemption or reduction, it does ultimately result in a reduction of your tax liability. The second parameters, these are the different things that you can tweak as you're creating a tax, different structural elements. Moving on to the next slide is the tax rate. A tax rate can be fixed or tiered. An example of a fixed rate is Vermont's sales tax, the 6% sales tax. That's just one flat rate applied to tangible personal property. Whereas Vermont's personal income tax rates are examples of tiered rates. And I did provide a little more here, although we won't really be talking about rates in this example, in this presentation. I just wanted to put out some basic tax structure information. Typically they're structured as a series of brackets. So something if you do decide to move forward that you might want to consider. Most tiered rates are structured to be progressive. So liability increases smoothly from one bracket to the next. And then the taxpayer only pays the assigned rate for each dollar within that bracket. That's what we're all familiar with the personal income tax. Moving on to the next slide, I did provide hypothetical progressive brackets just as a sort of easy calculation example. A taxpayer with $10,000 in taxable income would pay $500 in taxes because all of their income would be in the first bracket, which is $10,000 times 5%, $500. So that is just a really quick primer. These are the different levers you can pull as you're creating a tax if you wish to create a new tax. Finally, looking at tax liability, and this is somewhat more important to this particular presentation because when you have a tax base times the tax rate, you get a tax liability. That's often an initial liability. You can apply credits to reduce that. Just a few slides ago, I mentioned exemptions or deductions. Those are less valuable to a taxpayer than a credit because a credit reduces the tax liability dollar for dollar. So credits tend to be more valuable. They're also more expensive to the state. And I said that was more relevant to this presentation because I will be talking about income as it's used for the property tax credit as well as the renter credit. And I'm going to pause there and then I'll start getting into how income is defined and some different concerns about defining income. Okay, great. So moving ahead a couple of slides. First, I'll look at personal income tax, then the property tax credit, then the renter credit. And diving into personal income tax, this is the only definition that we'll be looking at today that is used as a tax base. There are three different definitions, and I walk you through them, how these are actually defined federally and how that then flows through to just walk you through how the law works in Vermont and where our definition comes from and where Vermont has leeway to make policy decisions about what is and is not part of the tax base. And to note, this is personal income tax revenues do go to the general fund. I know there's some discussion about funds earlier. Okay, so on the income, gross income slide, the federal Internal Revenue Code does define gross income as all income from whatever source derived. So that's your biggest catch-all. And then it has certain exclusions. And there's a sort of landmark 1955 case that said that income is any accession to wealth. So the general rule is that gross income, everything is included. Some examples that are listed in federal statute are wages, tips, salaries, commissions, rent, royalties, interest, dividends, et cetera. Cancellation of debt is one of them, and I bring that up because that's been in the news a lot. However, there are many exclusions from gross income. That is how the current treatment under ARPA, they're almost all student loan debt that's been canceled is being treated as excluded from gross income. So there, that's sort of that's where you really get into the weeds is there's this general rule and then there are many, many, many exceptions.
If income is any ascension to wealth, but I see wealth is generally sort of defined as holdings basically on some level, and income is, I'm not going to have the right words for this, but that's sort of what's in the paragraph makes me think that I'm just going to use the example of a stock rather than the proceeds from the sale of a stock. And the difference between those two things, like the difference between, I would think the holding of a stock would be included in any ascension to wealth. Maybe I don't really know what the word ascension means quite as well as I think I do.
Access.
But all of these examples would just be the sale of that stock, for instance. So where does that difference happen?
Another way of looking at wealth could be more as assets or holdings, as you're saying, and it's when you're earning, what you're earning from that's treated as income.
Okay.
Monetized.
When it's monetized, that's a good way to describe it. Also, this is again, this is not what's taxable. This is just the first definition, trying to get at as much as possible, and then it's chipped away at through statute.
Thank you.
Oh.
Right.
Yeah.
To me, it's, did Senator Cummings?
Senator Cummings,
You can see me now.
Tricia, move to you.
Oh, okay. I didn't move on my screen. For something like a trust fund, and I remember when we've had occasionally the guys sitting on the hood of their Porsche in front of their $1 million condo with a rebate check on their property taxes. If under assets, I have a trust fund, but I only draw down $80,000 a year in income, is that my income? And the rest of it is just wealth, but not income, right?
I think in that example that gets at what, yes, the discussion we were just having, but there would be so many specifics to the taxpayer situation. And again, that definition is gross income. So it's the umbrella. This is where we start and then it gets slowly chipped away. That is not the tax base. That's not what an individual's tax is being determined based on.
That's okay. That's what I thought.
Senator Pearson, do you have still?
Yeah, to me, I think it's a little easier when I think of just a piece of property, like a building, because it's concrete. And the value of that goes up, but, year over year typically, or often, but you don't realize any income from that increase in the value. And so it doesn't count as gross income until you sell. And so it's a holding. I don't know. That's how I think of it, is that it's simple, but I think we're all kind of saying the same thing. Okay.
Yes, whereas if you owned a property and you're renting it, the rents that you receive are considered income.
And the value of it would be increasing, but you're not utilizing that. Okay.
The next definition that is on the next slide is adjusted gross income, also we'll just colloquially call it AGI. And that means under federal statute, gross income minus a long list of exclusions and deductions. And I did not include all of them, but I've tried to highlight some of the most common and those that you'll see on different tax forms. So common ones are teacher expenses, IRA deductions, student loan interest deduction, tuitions and fees. And then I have a long list because those will pop up again in the household income definition in particular. Certain business expenses, reservists, performing artists, fee-based government officials. There are different pension and retirement plan deductions. There are health savings accounts, alimony that's paid, penalty on early withdrawal from retirement savings, et cetera. There are many, many adjustments. And I have included some the relevant citations both to the Internal Revenue Code and also to Vermont statute, if you are so inclined to go look through those lengthy definitions. So that's all for AGI. AGI is, I'm going to pause here because AGI is often looked at as sort of an easy, sort of shorthand, easy income base to use as tax base. But I do want to point out as we get into the next slide, it is different from taxable income. And there are some constitutional considerations about using AGI on its own without any other adjustments statutorily. So moving on to the next slide on taxable income. And this is what personal income tax is imposed on. First, and I've only spoken about federal definitions so far. I did put in a Vermont citation for adjusted gross income because Vermont statute does use that. But federal taxable income is gross income minus itemized deductions or the standard deduction, and then there are a couple of other miscellaneous deductions in there. Vermont, however, does not use exactly the same definition of taxable income. Vermont defines taxable income for personal income tax purposes as federal AGI determined without regard to bonus depreciation. And then there is a list of add backs of certain types of income that are added back that were reduced from federal AGI. They're added back in Vermont. And then there are other types of income that are subtracted from federal AGI. And I've actually say this twice in this presentation because I just want it to really sink in. Because it is one of the reasons that Vermont taxable income is different from federal taxable income is because Vermont is precluded. There are but there is both federal law and US constitutional principles that preclude Vermont from taxing certain types of income, from structuring taxes a certain way. This is where the constitutional limits come in. Other than those limits, the state can make policy decisions about what to add back. One example for a type of income that cannot be taxed in the state is railroad retirement income.
The one I was thinking of. It's my favorite, yeah.
And to everyone's mind. There are also, there are more principles of structuring the tax, or for example, another, don't know how common, maybe this is very fresh in everyone's minds after the retirement exemption discussion last session. There cannot be any discriminatory treatment against federal source income. So certain federal retirement plans cannot be taxed, whereas equivalent state plans were being given exemption, for example, either. Those are sort of the limits that the state has to operate within.
That's an example of something we add back in.
Oh, yes. So within that lovely definition in personal income tax is very long. State and local bond interest, when it's non-Vermont bond interest, that's added back.
Just to take us back up to where you say federal taxable income is gross income minus itemized deductions and the standard deduction and other miscellaneous deductions. What's the difference between that definition and adjusted gross income?
So that doesn't include itemized deductions or adjusted gross income. Maybe I should have brought a 1040 form for everyone to look at, but you have adjusted gross income and then you subtract your standard or itemized deductions.
So
above the line and below the line.
All right, so then just in that sentence, should adjusted gone in before gross income?
It's actually what's in statute. That's interesting.
Okay. Is it basically referring to the same thing?
You know what, I'm going to double check that. I think I took it straight from statute, but maybe I accidentally deleted adjusted.
Okay.
But I believe it makes reference to it. That's a good point. I actually tweaked some wonderful graphs that Graham Campbell, formerly at JFO, had done in other presentations. They're now more my work, but they're also, I just want to give him credit. In the next few slides, I've tried to make some graphics that show you how it flows through, so it's a little clearer. And I think you're actually correct because I did have AGI. So I'm sorry, that should have said AGI minus itemized deductions. And then the next slide that starts with federal income tax definitions, then in ellipses, this shows you how it flows through. So we start with, and this is from the form 1040, the gross income, big definition that pulls in all accession to wealth, wages, salaries, tips, dividends, capital gains, et cetera. Then you have subtracting the above the line deductions, teacher expenses, student loan interest, all of those. There's a huge, there's quite a lengthy list of those. And then you get to your adjusted gross income. And then moving on to the next slide, those definitions flow through to Vermont because Vermont starts with adjusted gross income. And I should point out also that that was a change in 2018. Previously, Vermont structured its personal income tax base differently, but this is how it is currently. So it's adjusted gross income plus the add backs for bonus depreciation, and then interest from non-Vermont state and local bonds, because those are allowed as adjustments to federal adjusted gross income. And then you have Vermont-specific standard deductions, Vermont-specific personal exemptions, and then other subtractions that were decisions made in Vermont that were policy choices that are now in statute. And those include interest income from US bonds, capital gains, certain, the capital gains exclusion is very specific in Vermont. There are actually two, one or the other. And I could get into more detail if you want, but I don't think anyone wants to go there today. Okay. There's also the Social Security benefits exemption, and then a very circumscribed medical expenses deduction. Finally, that is how you get to Vermont taxable income, and that is the tax base that is used for personal income tax.
I'm going to do a time check before we go on to the next section of this. So do you think we could get through finishing your section in 10 minutes?
I can abbreviate a lot of the slides for the household income.
Okay.
It's a lot of lists.
Okay.
That I wasn't planning to read to you.
Great. Thank you.
Just so it's more for your information.
And Jake, are you okay if we go a little bit into lunch with your presentation?
Sure.
Okay, thank you. Is everyone else okay if we go a little bit into lunch with Jake's? Great. Okay.
See how good it is, I guess.
Yeah, this is true.
Jury's presentation.
Presentation.
Back to you, Abby. Thanks.
The next slide is on the property tax credit and the definition for household income. Now we're back in the education fund. This is the only definition of income that I pulled that impacts the ed fund. So now that I'll move on to the next slide. Now that we're talking about credits, I just again want to highlight this is not the tax base. These are definitions of income that affect the tax liability, so it reduces tax liability. And the first slide on household income gives sort of an overview, and then maybe I will just sort of breeze over the next few slides, which are really lists of what's in and what's out. Household income is intended, so the purpose of it is to approximate the amount of income that a household has, that they have available to pay property taxes. To remember, this is not based on filers. This is whoever is living in the home. It's not like personal income tax where you can have a spouse and you can have dependents. It's actually adjusted to the number of individuals. This is one household, one property tax credit. So it's not a tax base. It does determine eligibility, as we were discussing earlier. When you hit above the threshold, you max out, you can't claim a credit. It's not about how much, it doesn't determine the tax base, it's how much you ultimately pay in taxes. Household income is defined in the property tax credit law as federal AGI. So we have, again, this AGI definition popping up with certain additions and subtractions. So I will maybe not walk you through the long lists. It's a lot of.
I just want to clarify. So household income in Vermont is not the sum of the residents' Vermont taxable income. It's the sum of the residents' federal AGI.
It's their AGI and then the next few slides list everything that's added back and everything that's subtracted.
Yes.
And it looks at everyone that's living in the household. And there are, and last year this was actually a bill that you will be familiar with. There was a new it wasn't really a subtraction from income. It was an exclusion from the household of certain members of the household. So some members, such as live-in caregivers, people with home sharing agreements and refugees and asylees, their income is no longer included. The additions are often losses, alimony received. There's a long list. These are what would otherwise have been excluded in federal AGI. So those are added back.
And this is under the principle that this helps you pay your school tax.
Correct. It's money available to the household. And that language is no longer in statute. At one point, there was specific language relating to this homestead owner credit and the renter credit, saying, it approximates the amount that you have available to pay. That's no longer in statute, but this is looking at an entire household as opposed to filers for the personal income tax, where it's sensitive to the number of persons living there or that are part of the tax return group. Subtractions are Social Security and Medicare, taxes withheld, self-employment tax paid, child support. There is a list of what can be excluded from household income. And then I did list the adjustments that reduce household income because we just looked at those as part of AGI and what federal government allows as an exclusion, but not all of the federal adjustments are allowed to be excluded from household income. The next slides go on to the renter credit. So I'll just pause if there are other questions about household income. Again, that's just for homestead property owners. Great. And the renter credit, there was
Just to clarify, this is going to affect both the education tax and the municipal tax, the household income. Because there's the circuit breaker on the municipal tax as well.
Yes, that is the household income definition that's used to determine that eligibility threshold, those 47, 90, right, and then above 90. Yes, this is the definition that impacts that. That's correct.
Yeah.
But then the general fund makes the municipality whole, right?
For the municipal credits, I believe so. Yes, Julie.
Yeah. So it doesn't impact the municipality in that sense, but it.
Yeah, but I was just wondering you use the same household income definition is used for both.
Yeah.
That's great. That feeds into this next discussion about the renter credit. This was really divorced from the household income definition several years ago. It was Act 164, 165 in 2020. The renter credit had slowly become its own separate program, and 2 sessions ago, it was totally separated out and a new definition was created for income. So it is separate from household income. It is only applied to renters. This is a general fund expense, so this does not impact the ed fund. And again, this is a credit. When we're looking at income for the renter credit, it's determining whether the individual is eligible and then whether it reduces the tax liability. It's not the tax base in any way. And what I didn't really get deeply into the weeds of income because there's another sort of eligibility threshold based on federal law that this definition of income applies to, but that's not really relevant to the discussion here. So I didn't want to go too far into that. But if anyone's wondering why parts of I didn't lay out the calculation for this particular credit. Just wanted to look at how is it defined. So for the purposes of the renter credit, income is defined as federal AGI and then with certain add backs. And if you were looking at the federal 1040 again, it sort of starts with total income, which I think I wrote it down as line 9. So you start with federal AGI, you add back all of those adjustments that we were just looking at. Everything that was an adjustment is added back. You get to what's considered total income, and then you add back losses. So business losses, capital losses, net operating losses, sale of business, personal property losses, farm losses, all of those are added back, so they're not allowed. Any exempt interest that's received or accrued during the taxable year, that's also added back. 75% of the federally non-taxable Social Security benefits are added back, so that first 25% is still allowed as an exclusion from income. I'll pause there and then just make a few final comments on the credit. I just want to be sensitive to time.
The household for the renter credit, is that everyone in the rental unit?
So that is sensitive to the number of individuals who are in sort of a tax filing group. That was part of the.
What I thought, okay. And before that, it was just any unrelated people who happen to all be in the rental
Yes,
unit.
it was the same as the household income and all of it's where it only applied to one dwelling. Everyone there, their income would be included. And so that meant generally folks that were in roommate situations or had more individuals earning income, it would increase their household income and they might be above it would impact their eligibility.
Yeah.
Yes.
Abby, can you just remind us, in the new renter rebate scheme, does the renter go through and somehow, does the tax department, or maybe it will ask Jake this as well, but if I'm a renter, is my landlord's actual property tax for that building incorporated, or is there some average or rule of law, how does that work? I'm just trying to understand how deeply the system drills down.
I would need to go back and prepare that for you because I haven't looked at that for today, but that was part of the policy change that was made a few years ago, was because that trying to determine how much of rent is going towards property taxes is difficult to determine. So it's instead the credit program is calculated on fair market rent. So it's not looking at actual rent except in a few very specific circumstances where some of the old statute was retained, for example, on mobile home lots where the land is being rented, that old calculation is retained for those, but for everyone else, it's based on fair market rent and the number of dependents and spouse in the filing group.
And then some assumption on a percentage that goes towards the tax.
No, that has been.
It's become more of a rental subsidy, right? Rental credit.
Okay.
But now it's a
Still
percentage
trying
of fair
to
market
make up
rent.
for this. Yeah, okay.
Yeah.
That's just going to become, I think, pretty central to our trying to wrestle through the renter issue.
Yes, absolutely. And that is one of the charges.
Yeah.
Your committee. So as I mentioned, it is not a tax base. It's the income for the renter credit is to determine eligibility and then the amount of the credit. And it is a general fund expense. And the last 3 slides are about some considerations. These are not exhaustive, but a few that came to mind, and the constitutional limits are particularly important, but are in terms of drafting, that's my perspective, not challenging to overcome. And I provided a few examples of how this is done in other parts of Vermont statute. So for example, railroad retirement income, that's preempted by the federal constitution. There are other ways of getting around that. In personal income tax, for example, although it says taxable income is AGI and then plus and minus all of these different types of income, there's another part of Vermont statute that says AGI does not include income that's exempted from state taxation under the laws of the US. So there's sort of this catch-all. So it just says Vermont can't tax railroad retirement income. Sales and use tax, so slightly different, we're not looking at income, but it does make this reference to sales not within the taxing power of the state under the Constitution of the United States. Those cannot be subject to taxation. And property tax as well has a real and personal estate owned by the United States or federal government holdings. Those are not taxable. So it has this exemption within that tax type. In terms of a few policy considerations, as I mentioned, as you can see just from this slide, and this is not an exhaustive overview of every way of defining income. Federal law has many MAGI definitions, modified adjusted gross income definitions. Different programs have different definitions. It can get very complex very quickly. Creating new definitions can create complexity that can impact taxpayer compliance, can make it more challenging to administer, just things to keep in mind. That said, the legislature did just create this new income definition for the renter credit. It's not impossible, but it can be challenging. And using existing definitions, that's why so many of these definitions refer back to AGI, is because there's existing precedent, there is more certainty for taxpayers, and there's more just more certainty and awareness of how these different types of income are treated. And that concludes my presentation. I hope I didn't go too far over time.
It was great. Thank you. I think we just started late with you. It wasn't your timing. Your timing was perfect. Thank you.
Thank you.
So we're going to take a 10-minute break